Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. The rise in interest rates over the last year or so has really resulted in a lot of pain for dividend investors because a lot of dividend stocks now look less valuable when you can get the same interest rate but just buying bonds and not taking quite the same risk. But that actually presents an opportunity for long-term investors. As yields have risen, on the equity side, the dividend payout can grow over time, unlike it does with typical bonds. So if you're buying a stock now that has a 4 or 5% dividend yield, when a year ago it had a 1 or 2% dividend yield, long term, that can be a great spot to be buying for investors. And I want to highlight 5 stocks today that I think are really well positioned for dividend growth long term. My name is Travis William. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my content and turn on notifications so you know when a new video comes out. The first one I want to highlight is a company that you may not think of as a great dividend stock, but that's Best Buy. Best Buy was actually one of the big beneficiaries early in the pandemic because a lot of people were trying to buy electronic equipment, and Best Buy was a natural place to do that. That's why you see a jump in free cash flow, in their stock price, and also revenue. But that's come down to earth over the last year or so as the company has gotten to more normal operations and a more normal sales cycle. But the dividend is currently at 4.7%. And I think Best Buy has actually carved out a really nice position for itself. It's now doing a lot more things like pickup orders. It's actually a showroom for a lot of companies that are trying to sell their goods. And it's really leaning into the realities of the digital economy. I think that's something that it took a long time for Best Buy to adjust to, but we're really starting to see the fruit of that transition. Now, this isn't a company that I would expect to grow a lot over the next 10 years or so. But if they can just maintain their market share, maintain revenue, and keep paying a dividend yield of 5% or so, maybe grow it a little bit over time, that's going to be a great spot for investors to be in. And I think a lot of people are looking for alternatives to shopping online, want to do a little bit of in-store research, and Best Buy is going to benefit from that. So if you don't have this as a dividend stock on your radar, I would definitely put it there. Stanley Black & Decker is another one, been paying a dividend for a very long time, actually facing some tough times right now. Let's look at the chart here. You can see that free cash flow is actually negative. The dividend is shot up as the stock price has come down, and a lot of this is coming out of the pandemic. There's a big drop in demand, specifically on the volume side for Stanley Black & Decker's products. When you have a company like this, there's a lot of operating leverage. So that means that when volume declines, you still have to pay the people, pay for materials, pay for the warehouses. All those expenses still happen, even if you're not producing as many goods. So there's been a big adjustment for the company. They've decided to shut down some of their plants. They're reducing costs across the board. And that's the pain that we're seeing right now on the income statement. But as we look to the future, this is a company that I want to be buying and holding long term. I don't think we're going to be using fewer power tools or lawnmowers. It's just a matter of when are people going to be making those purchases and how much are they going to be spending. This is the kind of business where there's only a handful of players. So there's a limit to how much competitive pressure there's going to be in the market. All these companies are going to want to make money because they're manufacturing companies. And eventually, I think we'll return to a more normalized earnings environment. Given the dividend's current yield of about 4.3%, I think this is an attractive buying opportunity for a dividend stalwart long term. We need to make sure that some of those cost reduction measures do go into effect, that maybe we know that management is starting to prepare for a very weak economy. I do like to see that preparation because that means when things do improve, we're going to see a lot of leverage on the bottom line. So maybe the kind of stock that you have to hold for 5 or 10 years to really see that upside. But in the meantime, we get a really nice dividend. 2 that I'm going to lump together because they're very similar businesses is Verizon and AT&T. These are telecommunications companies, generate most of their money from wireless services. And this is a oligopoly. There are really 3 providers in the US, Verizon, AT&T, and T-Mobile. These are kind of the tier 1 leaders. They're charging a little bit more to customers. Therefore, they're generating a little bit higher margin and actually have better return on assets than T-Mobile does, despite the fact that they're not maybe growing quite as quickly. What I like from both of these companies is that they're moving into 5G. They're generating a ton of cash and they're paying a big dividend. I think these businesses are much stickier than a lot of investors think because it's very difficult to change your mobile plan. And over time, people are adding more and more devices, not only things like watches, but now cars, all kinds of other products are coming. And we're also seeing growth in fixed wireless, which is broadband wireless that's coming into the home. So that's replacing things like cable. That gives companies like Verizon and AT&T the opportunity to bundle not only smartphone wireless service with your broadband wireless service, but also add in things like streaming content. That's something that I know that Verizon is doing. AT&T actually spun out its content business, but that actually allows it the opportunity to bundle in all kinds of other services. So I really like that position from a strategic perspective. They have the cash flow, they have the spectrum. Now it's just a matter of generating that operating leverage, growing revenue slowly but surely. You don't expect double-digit growth, but single-digit, even mid-single-digit growth is going to be really impressive for these companies. As long as they keep paying these dividends long-term, 6.5% from Verizon right now, 5.6% from AT&T right now. I think this is a great basket of companies to own and great piece of any dividend portfolio. The final company is Brookfield Infrastructure Partners. This is a company that buys infrastructure assets that generate money over the long term. Water assets, ports, energy assets. It holds assets that are going to generate free cash flow over the course of decades, and it pays a portion of that back to investors. The dividend yield right now is 4.5%. This is a company that has a long history of adding value to shareholders. The Brookfield suite of companies is really known for their capital allocation, being aggressive when it's time to be aggressive and being conservative when that's appropriate. And I think this is one of the best pieces in that suite of companies because it's investing in assets that not many other companies can invest in. It's not going to be the most exciting company. It's not going to grow revenue or earnings in double digits, but if it just continues to pay that dividend of 4.5%, that payout has grown 8% per year over the last decade, from 69 cents to $1.53 per share. That's the kind of slow, steady growth on the dividend side that investors want to see. And that's what you can get from something like investing in infrastructure. So Brookfield Infrastructure Partners is one of those companies, is just kind of set it and forget it piece of a dividend portfolio. So the companies we highlighted today that I think are great dividend buys are Best Buy, Stanley Black & Decker, Verizon, AT&T, and Brookfield Infrastructure Partners. Let me know what you think about those dividend stocks in the comment section below. Don't forget to subscribe to Rive Investing. Thanks for watching, everybody, and I'll see you here next.